Welcome back. If you've been following along with our curriculum, you know we've covered a ton of ground. But today is a massive milestone. We are unpacking day 9 of the Crypto Trader curriculum, and our entire focus is on moving averages. Seriously, if you've ever looked at a crypto chart and felt like you were just staring at complete, unpredictable randomness, you are absolutely in the right place. Today is all about cutting right through that market noise to find the actual signal. We're going to build a rock-solid understanding of what is easily one of the most powerful visual tools you can have in your trading toolkit. So, how do you actually spot a trend in all this chaos? It's the central dilemma of day trading, isn't it? You pull up a chart for your favorite coin, and the price action looks like a heart rate monitor going absolutely haywire. It's up 5%, down 10%, you've got wicks flying everywhere. In the pure, unadulterated chaos of the crypto markets, how do you know if the market is actually moving up or if it's just a temporary blip? Well, the ultimate tool to find that clarity, to literally filter out the distractions, is the moving average. Okay, let's dive into this. Here is our roadmap for today. We'll start with the moving average concept, then compare the SMA versus the EMA. From there, we'll calibrate with the 3 key EMAs, learn to read signals through crossovers, and finally, wrap up by building your trend-following setup.
Section 1. The moving average concept, smoothing out the noise.
So what is a moving average exactly? At its core, it's a calculation used to analyze data points by creating a series of averages from different subsets of a full data set. But really, its main job is just to smooth out price action. You might be wondering, why does smoothing out data actually matter for your trades? Well, it matters because human emotions react to every little spike and crash. By taking an average of past prices, this tool draws a single, flowing line. It visually erases the erratic, minute-by-minute panic of the market, leaving you with the true underlying trajectory of the asset.
Section 2. SMA versus EMA. Choosing your tools.
All right, first up is the simple moving average, or SMA. This is basically the unweighted mean of the previous given number of data points. Think of the SMA as the steady tortoise of your chart. It looks back at a set period, let's say the last 20 days, adds up the closing prices, and just divides by 20. It treats all historical data exactly the same. The price from 20 days ago holds the exact same weight as the price from 5 minutes ago. Now, it's incredibly stable, sure, but because of that, it can be a little slow to react to sudden changes.
Now, contrast that with the EMA, the Exponential Moving Average. The EMA is the reactive hare to the SMA's steady tortoise. It places a greater weight and significance on the most recent data points. So instead of treating all historical data equally, the math behind the EMA prioritizes what happened today over what happened last week. And because of this weighting, the EMA responds almost instantly to the most recent price action.
Let's put them head to head. On one side, you have the simple moving average, giving equal weight to all data. On the other, the exponential moving average, giving heavier weight to recent data. Think about it. Which calculation do you think is better suited for highly volatile crypto markets? In a market that operates 24/7 and can pivot entirely on a single news headline, speed is often your best friend. While both are super useful, our curriculum definitely leans into the EMA for active trading setups, simply because it hugs current price action much closer.
Section 3. The 3 key EMAs. Calibrating your timeframes.
Now, what's really interesting about this slide is how these specific numbers, the 20, the 50, and the 200, capture completely different market speeds all at a glance. By combining these 3 together, you're essentially looking at the present, the near past, and the deep history of an asset's momentum, all simultaneously.
Let's break them down, starting with the 20 EMA. This represents the short-term trend. Because it only calculates the last 20 periods, this line is going to move fast. It tracks the immediate momentum of the market. When the price is aggressively rallying, it'll ride right along the 20 EMA. If you're looking for short-term entry points or trying to gauge if a sudden spike has any real legs to it, this is the line you want to watch.
Next up is the 50 EMA, which dictates the medium-term trend. This is your middle ground. It's not as erratic as the 20, but it's not as painfully slow as the deeper historical averages either. Traders use the 50 EMA to confirm the broader direction of those shorter-term moves. So if the 20 EMA is moving up, but the 50 EMA is still pointing sharply down, well, you know the medium-term momentum hasn't quite shifted in your favor yet.
And finally, we have the heavyweight, the 200 EMA. This represents the long-term trend. This is your macro indicator. It really helps traders determine the overarching market environment. Are we in a raging bull market or a brutal crypto winter? The 200 EMA will tell you. The absolutely crucial point here is this.
If the price is consistently trading above the 200 EMA, you are generally in an uptrend. If it's below, you're in a downtrend. It acts as the ultimate line in the sand for market sentiment.
Section 4. Crossovers. Reading the signals.
Okay, so we have our lines. Now let's look at how they interact dynamically. A crossover is exactly what it sounds like. It's a point on the chart where a faster moving average, like our 20 EMA, intersects with a slower moving average, like our 50 or 200. This intersection isn't just a visual curiosity, it's a critical event. Crossovers are the actual trigger events that traders look for. They signal a very real mathematical shift in market momentum.
The basic logic of a crossover tells a really compelling story. If your short-term fast EMA crosses above your long-term slow EMA, that tells you recent prices are surging higher than historical prices. It signals upward momentum. You'll often hear this called a golden cross. Conversely, if your short-term EMA drops below the long-term EMA, it means recent price action is drastically weakening compared to the past. This signals downward momentum, often referred to as a death cross. Letting a fast line interact with a slow line just takes all the guesswork right out of momentum shifts.
Section 5. Your trend-following setup, from theory to practice.
Let's walk step by step through building this simple yet incredibly effective trend-following setup, and this brilliantly illustrates how everything we've talked about combines into action. Step 1. Go into your charting software and apply the 20, 50, and 200 EMAs. Step 2. Zoom out and identify the overarching trend using that 200 EMA. Remember, if the price is above it, we're looking for buying opportunities. If it's below, we are very cautious. Step 3. Once you know the macro trend, zoom in and look for crossovers between the faster 20 and 50 EMAs to actually time your entry. If the macro trend is up and the 20 crosses above the 50, bam, that is your signal. This entirely filters out the noise, confirms your direction, and gives you a distinct, actionable trigger.
So we've unpacked the concepts, chosen the EMAs, and built the system directly from the Day 9 syllabus. The noise of the crypto market doesn't have to be overwhelming when you have the right tools to smooth it all out. So here's my final question for you. Are you ready to apply this trend-following setup to your own charts? Take a minute, open up your trading terminal, set up your 20, 50, and 200 EMAs, and see if you can spot the story the market is trying to tell you. Keep learning, keep analyzing, and I'll see you in the next